Hello, everybody. This is Crypto Rookies once again, and accompanied by Jane. Hello, Jane. How are you?
Hi, Patrick. All good. Quite excited for today's topic as well, going through some calculations. And yeah, I'm really interested how it all works.
Yeah, we'll look. I forgot which session we are now. Is it 4 or 5? I'm not sure, but we'll look into liquidity pool on a decentralized exchange. That's usually how token usually launch first. And yeah, there's a little bit intricacy about that. I'll share my screen.
When the liquidity pool is empty, and you'll be the first ones to invest your capital, right? So the procedure of calculation, it will be the same one. Compared to if it already exists, there are lots of people inside, and you just enter after some period of time.
But it's like, typically speaking, the project will be the first to put money into the liquidity pool. So they create liquidity pool, and then that allow you to trade, to buy or sell, depending if you already have the token or not.
So they probably take the reserved capital that they have of tokens, and then some part of it they invest into liquidity pool, right? And then some of them they leave as for some emergencies.
Yeah, the thing. So typically, all projects they reserve some of the token supply, and then when they do a pre-sell or like whatever way they can get their hands on stablecoin, typically speaking, they get 2 tokens, and then they put them together in a liquidity pool, and it has to match. It has to be balanced 50%, 50%. But I think it depends what the price of your token you want it to be. So you could have 1 million token versus only dollars of stablecoin. But like, if you only have $100 of stablecoin, then the price movement will be exponential when people buy or sell your token. So ideally, you want it to be large enough. But the thing is, if you have to put $100,000 or $500,000 in your liquidity pool, that means that you need to finance this from somewhere. So that's typically project finance this from doing pre-sale of their token. And I've seen projects who made mistakes with the calculation where they didn't allocate or kept enough stablecoin compared to what they claimed they were going to put into the liquidity pool of their own token, because it has to match and be balanced. So the thing, Uniswap is one of the most well-known decentralized exchange. So that means that any project can list their token there. They don't have to ask permission to anybody. There's no validation or something like that. So that's the typical interface that you see where you can swap from one token to another. But if you go to pools, and that's where there's a lot of existing pools because projects have been listing your tokens there for a long time. But if you want to make a new liquidity pool where you just created your own token, you would go to create a new position and you would add like something there. But like right now, I just want to show you existing pools that already exist.
But when you do an exchange between one token and another token, and Uniswap will take the commission fee.
Yes, and the thing, depending on who created the pool, they can decide if it's 0.3% or 1%, but that can be adjusted also. And so it's loading slowly, but okay. So here we can go look at the pool. So this one, the transaction fee is 0.05% because there's so much volume that even that small transaction fee collect quite enough of return. So the important thing here is that the TVL, that's the total value locked. So that means that people put right now, because of the ratio between the USDC and the wrapped Ethereum in this case, there's 1.93 thousand wrapped Ethereum and there's 0.52 million of USDC. So the two together, it's $8.14 million that is total value locked. So that could be wrapped in or USDC that they're the project owner and they create the token, the liquidity pool first. And then anybody else that own those 2 tokens can go and add liquidity. So I could do that, you could do it. And then you collect a portion of the transaction fee when people swap between the 2 tokens. So you don't have to ask permission. You could have passive income coming from that. So right now there's a TVL of 8.14 million. That means that there's $4.7 million worth of USDC and $4.7 million worth of Ethereum. But because of the price of Ethereum is a lot higher than $1 compared to USDC, that it's $1 compared to USD currency. That means you need a lot less in the pool to be balanced 50-50. When I say 50-50, it's not necessarily that you need the same amount or equal amount of token in both. It depends on the price of the token. What's important is 50% of the TVL, like 4.7 million of Ethereum, of USDC, and the same of Ethereum.
So the proportional percentage, has to be around 50%.
Yeah, I think it has to be an equal amount in the price of the token when you consider the amount of value of the TVL. And then
it's not the case?
No, that's saying it cannot be not the case. Uniswap, the way it works, this is always a proportion of 50-50.
Okay.
You could have unbalanced liquidity pool, but that's typically used by Dutch auction on Balancer, for example, when you're trying to launch your token at first and you don't know what is a fair value, then you can have unbalanced pool that balance over the course of the auction. This enables you to launch your token without as much, let's say, stable coin or whatever matching pair of the token is that you need to finance that matching pair when you create a token and you create a liquidity pool at first. So if you don't have the money, a Dutch auction with the unbalanced pool is one way to reduce how much money you have to put in. But I think Uniswap specifically, it's always 50-50. And the other important piece of information here is there's in the last 24 hours, the trading volume was $17 million. So when you compare this to the TVL, this is what gave you that if you are a liquidity provider, the entirety of the liquidity provider split $8,000 basically of fee that was collected in the last 24 hours was split amongst all of the providers in equal proportion to how much they've put there compared to the TVL. So this includes
Others usually receive this fee.
it can be anybody. You can go if you have a certain amount of USDC and wrapped Ethereum, you can be a liquidity provider and you can be collecting a portion of those fees. So if you want to know how much you are collecting, let's say that you contributed, let's say $1,000 of the 8 million divided by 1. So in this case, you have 0.012% of the liquidity pool with your $1,000 of investment. This is the percentage you'll be collecting of the transaction fee of $8,000. The thing in this case, the passive income from that is not massive, to be honest, but it depends because some days there are spikes and the TVL may not change as much because people cannot readjust where they allocate their money. But so that means that the fees on a daily basis can change quite significantly. So yesterday was not massive, but okay, it's not so bad. So the point is that depending on the liquidity pool, the TVL could be a lot smaller compared to the transaction volume, in which case you collect a lot more fee and it's a lot more passive income. And there's projects that like Curve, for example, that enable you to reallocate where your money is allocated so that you can try to maximize those transaction fee. But it's a good way. If you own a house, that would be like for example, owning USDC and wrapped Ethereum, you put them to rent. And this is the passive income that you collect.
The higher volume you have, and then the fees will be higher. So which means you will gain more money from the fees.
Yeah, the thing. So if the transaction volume compared to the TVL is high, the ratio, then your passive income will be quite decent. I think in this case, because those are pretty like safe assets, the return is not that high. But I think I've done some liquidity farming like this in the past, and I was collecting about 200% per year. So I think then you have more risk with impermanent loss and other stuff that comes in. But like the goal of the day is not so much to go over that type of things, but my point is that it could be a lucrative way to make income. But when it comes to someone who's creating a token, you need to be creating a liquidity pool often at first to basically to allow your users to swap back and forth between your token and whatever pair you put as a pair. Most of the time it's stablecoin, but it could be Ethereum or Bitcoin or some other things. So
but what will happen, for example, in case, so this is just the beginning of when they have created the token, they're going to release it, and just these first moments when you put the money into the pool. Yes. How would it affect in the future if you enter at the beginning and you invest money?
Exactly. That's what I'll go over right now. The calculation, it's easy for someone in mathematics, but yeah, it's arithmetic and it's confusing at first, but if you play with the formula quite a bit, then you'll understand. So the basic formula because of this is all fully automated. So there's no market maker that try to match a sell versus a buy. So that you don't have a matching provider. It's handled by a formula. And the formula is basically Y times X equal K, and K is a constant. And the thing Y is basically the quantity of one token versus the quantity of the other token as a pair, give you a constant, and the constant remain fixed. And the thing, when you put numbers into this, what it looks like on a graph is what we refer to as a bonding curve. And this is also often called as an automated market maker. So the automated market maker is basically the bonding curve like this, combined with the exchange itself, enable you to not have a market maker that get involved in matching transaction. It's all fully automated by a formula and by just programming code. And the way it works is that when a lot of people, let's say, swap or like in one direction, let's say that you're trading one project token for US currency, and most of the people are doing the same thing, swap, and there's not that many people who swap on the other direction. You're going to be moving along the curve in one direction, but you're never going to go to zero or to an exponential, the curve will be exponential on both sides to prevent a collapse. So that means that the price will never go to zero, but it will become very small at some point if you get too far along the curve. And that's the same thing in the opposite direction. The price will become extremely high if you get too far in that one direction with the tiny amount of the other token that you swap. And let's put this as actual calculation here. So I'll put a formula that's, let's say, on a Google Sheet or like on Excel, whatever spreadsheet you're using to make things simple. I have my K, I have my Y and X. So let's say that I'm putting $100,000. So that's a quantity of, let's say, USDC.
Like a stable coin, right?
Yeah, exactly. Or USDT. And this is your project token. We were discussing favor last time. Let's keep it as that just for fun. So now the project decide how much of their token they put. Let's say that they only have $100,000 of USDT that they can allocate to this. And let's say that they want the price of their token to launch at 50 cents. So that would mean that they would have to put twice as much token of their own token. So 200,000 favor token. And then let's say
But is it always the correlation between stablecoin and the token itself has to be higher?
No. The thing, you could decide that you put just 50 token here. It's entirely up to you. But typically project, they have a lot more supply of their own token because they created it for free to themselves. The stablecoin or whatever pair they're matching with, that usually costs them money. They have to finance this from somewhere. So they're saying a lot of, and I'd say there's also psychology. People like launching a token at a low price because psychologically speaking, people assume that if it's a low price, the price will increase faster. That's not true, but that's what people assume. So I think just for the fun of it, let's keep it as 200. Okay, and then if you're not sure what is the price of your token, you say P of X, so the price of token X, which is favor. You say this, which is your Y divided by your X, Y divided by X. So this is the quantity of Y divided by the quantity of X, give you your price. And because in this case, UT is equivalent to $1 each of those quantity, that means that this is 50 cents. Okay. Now let's say that you're a new investors and you're the first one to go in and you want to buy favor and you're with, like, okay, before we do that, K is a constant. And as we said, it's Y times X equal K. So let's do it. So this is this like big number, but don't worry about it. This is a constant. So whenever someone come in and they want to buy, let's say or let's go for $10,000 of USDT that they want to get a certain amount of favor. So your K has to remain constant. So we copy it. Now this one, we take this one, and then we put an extra $10,000 because you're swapping a certain amount of, sorry, it's a plus. So you're adding $10,000 into the liquidity pool. And then you have to calculate what is this. So you do your K divided by this one. And this is the remaining quantity left. So the first investor traded $10,000 in order to get 1,181 favor token. And it's saying the person paid $10,000. So this divided by 10,000. So the person paid $1.81 on average per token. But remember the original 50 cents. And that's because $10,000, it's a large amount of the liquidity pool. And as I said, this bonding curve, the least amount of money you have there, the faster you're going to move along that curve. So this is why when you see a project with a very little amount of SDT or stablecoin in their pool, whatever amount of money you're going to put first will exponentially grow way faster. And like a project sometime or investors like this, because if they are the first and then they sell not too long after, whatever new investor come in will keep pushing the price really rapidly. So some project can experience 10,000% growth in a month. But just that it's just because that pool is small. So to me, that's really artificial because I'll show you what happened next.
So you would say like having the like 100K of USDT in the pool, it's not that enough, right?
It depends how your users will be buying. If you have whales that buy for $10,000 and $100,000 in the pool, it's not enough. But I think like here, that person paid on average $1.80 on average for their, but the current price after this person bought is actually, just like we said, Y divided by X. Oh, I have a calculation error somewhere. I did make a mistake. I probably made a mistake on this price here. 10,000. Oh yeah, here it was inverted. It's $10,000 divided by the by this number. Sorry. Aha. Okay. So the person paid 5 cents on average for this token. But because you moved along the curve, now the new current price on the exchange is 61 cents. So the next person that come in may think that they'll be paying 61 cents if they're buying. But that's only true if they buy a very small amount. Because if they buy for another $10,000, the same thing will happen is that they'll be moving along the curve. And I think at some point, if a ton of people, let's say, I'll show you what happened. Let's say someone buy here for $90,000. So now we double the size of the amount of stablecoin in the pool. Now K has to remain constant. So now this has shrunk by half. Now the new price of this is not, the price didn't just double, it quadrupled.
Yeah.
So the person here that bought this token at 55 cents each, by that time, now their entire token pool is worth $2. So now they spent $10,000, but now they have $36,000 of value, if you would call it that. But the problem is,
and if he sells all his tokens that he bought,
that's it. Let's do that. Because that's the problem, is that price is not really true if the liquidity pool size is small versus how much token you're selling. It's like a bank run that I was explaining the other day, is that the amount of token into that pool is act as a bank. But the problem is that the growth of value for all of users is way too fast compared to what it should be, because the bank is way too small compared to the entire value that is created. I think the value, there's only twice as much, like there's only an extra 100,000 here. But let's say that you allocated 10% of your supply here, like Favor. That means that the entire fully diluted market cap of Favor is way bigger than the size of the bank and the size of anything. So that's the problem, is that there's too much value being created too fast when your liquidity pool is that small. And that's why a lot of meme coins launch at an extremely small size of liquidity pool, because they want to see the early adopters gaining like thousands of % of growth. I've seen recently it was a new chain by Coinbase, like the base chain. They launched a project, and the token was called Bald. Let me show you just as an example. It only lasted one weekend, and it was a meme coin. And whoever created it, they did a rug pull, but now they are claiming that they denied this. But the price collapsed entirely after 1 weekend. But there was more than 1 million % growth in 4 days. So
in 4 days.
Yeah, but that's the thing. It's the liquidity pool that it started with was extremely small.
But is it like on their hands of owners of that project or owners of that token to control the volume? Because you don't want to have this a bad image of this project. Like you want to keep it more or less like healthy and safe. So is there a way to control how much people can invest, how much they can buy tokens?
In pre-launch, yes, but on Uniswap, you cannot really control how much people will buy. So ideally, you want to do some pre-sale or raise money from like private investor like VCs, so that your liquidity pool, I would say that you should try to aim for at least 500,000. I've launched a token before that had 250K as a starting liquidity pool. But early on, I didn't start with a massive amount of marketing and all that stuff. So I had very few buyers early on. So the price didn't skyrocket that much. But the thing, like, earlier we were talking about this here. Let's say that your first investor want to sell after this. So
the price has increased.
Yeah. So minus, okay, in this case, we are looking at the X, because now it's going to swap these token back into the liquidity pool. So it's this number plus this one. And then because your K has to remain constant, it's K. This time it's divided by this. And now the price, there was $18,000 that went in. The price went up quite a lot, but the price decreased a lot faster, as you can see. And let me show you. So this person now, basically, there was this much into the liquidity pool in stablecoin, and now there's this much left. So the person left with $30,000. And they had, because here, if it was at the market price, they had $36,000, but they only managed to get $30,000 out because I think the bonding curve was moving along the curve while this wasn't. So I think the bonding curve is a pretty amazing way to manage this, so that you never run out of token on either side. But at the same time, it creates what we call slippage, so that if your liquidity pool is small compared to the amount of money that you're transacting with, there's a lot of slippage. The slippage in this case, it's going from $36,000 to $30,000. You suffered quite a bit of slippage in terms of percentage that you should have. Technically speaking, if the liquidity pool would have been very large and your transaction size would have been small in comparison, you could have get back almost the entire $36,000.
And usually, if this case happened, the one that we have calculated, those 6K, usually where they go?
Yeah, it was artificial money from the start. It didn't really go anywhere. It was just fake artificial money. It's an artifact of the bonding curve formula. And that's why a lot of people struggle understanding this. But to me, first, a lot of projects make a mistake that they don't keep enough stablecoin to finance properly their pool. And then when they launch, they experience skyrocketing price increase, and they think, oh, that's amazing, we made a lot of money. But it's not real money, because it's artificial, and people got enriched so fast that this person, maybe this happened in 1 day, that the person put $10,000 and left with 30K. So it's a 3x investment. So that's saying when the price go that fast, the incentive for people to cash in profit and basically dumping on the new investors increase. So when people get 1,000% growth in 4 days, do they really want to risk and getting to 1 million %? Or they want to cash in some gain? At least they should recover their initial investment. But the problem is that the people who come late get really screwed by those mechanics. So if you're thinking of investing into a new project that is only listed on a decentralized exchange, go look at the size of the liquidity pool and see how much you can allocate in a way that you're not going to make the early adopters so rich that they want to dump on you and cash in their gain, and then you're the one left with having lost quite a lot. Because I think this person, now the price is $2, but it shrunk back quite a lot. So with just that $10,000 It was $10,000 that they bought, but this amount of token was a lot. So technically speaking, the person who put $90,000 here, they only got 81,000 token. So that's the thing. It's much more costly for them to buy this token compared to the first buyer. So yeah,
probably the second one was screwed with the price because he bought like for two.
Technically speaking, he didn't spend $2 per token because of the same reason. Like the average it was $90,000 minus divided by this amount of token. Yeah, he spent on average $1.1 per token. I think whoever buy after that person, the price started at this point, and then depending on how much you're buying, you keep going along the curve. And that's the problem, is at some point, imagine those tokens there go to there's only one token left. That is called like a liquidity crunch. And technically speaking, if you're looking at Bitcoin, we were talking about Bitcoin the other day, there's very little amount of Bitcoin left on exchanges for the potential buying volume that is coming with the institutional buyers. Because some of them have such deep pocket. If they buy for $100 billion worth, there's not that much Bitcoin left on exchanges. So the price may skyrocket. So that's why some people believe that the Bitcoin price could go to $1 million in the next year or two. It's not ideal to have so little amount of token. And I know you can buy fraction and all that stuff, but at the same time, it makes the price go really exponentially high at that point, and people get enriched themselves way too fast, and it causes massive fluctuations. So to me, it's more a problem than a benefit. This is why I recommend for project to have minting capability so that they can mint and add a bit more to reduce the speed of growth, so that you don't encounter this, that it's kind of more like artificial value. But the moment people start selling and there's a panic going on through, everything will crash so much that everybody will suffer more that way. So ideally, if you can mint and you can have collateral set aside, like I'm explaining, you can try to make this a little bit more sustainable and prevent collapse of your economy. So another thing I wanted to say, I've seen a lot of projects that they like to have an unlock at TGE itself. This means that the moment this liquidity pool is created, there will be people who got the token, like the favor token, they got them previously either for free or at a discount. And sometimes the discount can be quite significant. And that means that if there's an unlock at TGE itself, they can sell. So there's no vesting, or if there's vesting, there's a certain percentage that unlock. So I've calculated often when I consider investing in a project, I calculate how much unlock, if there's any, at the day of the listing itself. And let's say, imagine that you have 50,000 token or whatever amount of token here, because you can calculate how much token that represent. And in worst case scenario, if there's no buyers and all of those people sell everything they have as soon as they can because it's enough profit for them, often the liquidity pool itself is smaller than this amount of money that they're selling. So this can be very catastrophic. In this case, let's say that we're still, I put some arbitrary number, like it doesn't imply anything, but so that the price here goes to, okay, so maybe 50,000 was not that much, but let's say that we go extreme and we put 100,000. In this case, the price could go below the listing price itself. And it's that happening all the time, where the price of the project collapses entirely because the people who got free token or discounted token before sell as soon as they can. And then if the buying volume is not enough to offset those sellers, the price start to go down. And when people see that, it's panic at that point, and the buyers don't want to get involved because they want to see how deep it's going to go first. So at that point, it's basically game over for the project. Often they don't recover from that.
So if you swap the tokens, so I have like favorite token and then I want to exchange to another token.
Yeah, that's the thing. Ideally, you want vesting, that people get token either at a certain interval of time or on a linear vesting like we discussed, or daily, all that stuff. But ideally, I would put very little token that unlock it at TGE itself. And sometimes it's the investors that ask for that. But if they ask for that, it's likely that they're not the right investors for your project. All they want is a pump and dump to cash in their profit as soon as they can. So I would not trust investors that make that requirement to have unlock at TGE itself. I would prefer that maybe a week after TGE, after listing, then maybe there's some unlock that starts. But you want the dust to settle first. You want the price to stabilize. And then I would try to avoid having massive unlock at any point in time. We discussed that last time, but it's never a good idea to have very large unlock, because it's really hard to predict what will be your buying volume. So until I would aim to not have any unlock on the day of the listing itself, you know at that point, okay, how much is it? And then maybe you decide at that point that most projects, they have a fixed release schedule and unlock schedule, which is, to me, I'm never a big fan because you don't know what's the market adoption.
So you would say like going to Project Insight and looking for a white paper where they can have a schedule of listing, etc. So more or less you can have a picture how healthy this project will be.
Yeah. I think if the project are really smart, they can put a certain amount of stablecoin here, large enough for the volatility to not be extreme. And then they could probably keep aside a large amount of stablecoin just to protect their token. And I think if they have unlock at TG itself, because whatever reason, as long as they have enough stablecoin to protect their token from an entire collapse, then it's fine with me. But the project don't have those mechanisms in place. So yeah, it's very risky, but I would highly recommend for people to get familiar with those bonding curves. Because a lot of projects launch on the centralized exchange as a first step. It's often a lot cheaper than launching on a centralized exchange. Understanding this and being able to make calculation based on the white paper will give you a good idea if you should invest in a project or not. If the project launch as a meme coin, maybe put just $50 if you really want to take a risk. But personally, I don't put 10,000 unless you're very rich. Don't put a significant amount of your capital if it's something that has a very shallow liquidity pool. And, if you cannot see it in the white paper itself, go on the Telegram or Discord of the project and ask what is the breakdown of those details.
And then you can make calculations to see where it goes and if it will make sense to invest your money into this project.
Exactly. And I think for me, favor seem like decent in terms of economic, but I constantly project on that it makes no sense at all. And I think it's pretty obvious that they might pump and like scale like crazy, but don't risk a large amount of money. Just put a few dollars, because if they scale like that and get 1,000% return, just $10 is enough to get rich. You don't need to put that much. But chances are it's going to collapse pretty quickly after launch if it's not done properly.
But I think it's like in the future will be potential to control the volume of how much people can invest, in the sense of if you are the first one and you invest like 10K and the system will tell you, no, sir, but there is a limit and you can invest only 2K.
Yeah. But I think on the decentralized exchange, there's no such mechanism right now. But on the launch pad, there is. Because projects want to prevent having one user who get 50% of the supply. So that happens, but that's on launch pad. That's basically before you list your token on the exchange themselves. I've never really seen something like that happening. It's pretty free market in that sense.
I think once you have the example of how it, like the structure, or if it's itself, the calculation, I think there is like a decent like logic behind of it.
Yeah. And at some point, there's also tricks to manipulate K, but that's a bit more too advanced for today, I think. Like that's for project owner more than investors, I would say. All right.
Yeah, I think it was quite clear. I've done like some reading before, but itself, how they've been like giving the examples was a bit tricky because they haven't been giving like a real examples. It was like more under the fraud examples, at least what I have seen. So for me, it was a bit confusing.
Yeah.
But now I cleared out everything.
For me, it took time also just to play with those formula and make some calculation. But when you do it, you understand a lot better how that things work, and then it's a lot easier to analyze project. And I think I avoid a lot of project simply because of those things are just not making any sense to me. It's too risky.
Yeah, just don't waste time. You see it already.
Exactly. And I think if this is something that just you really struggle with, just go to Cyrator, and like people like me and other people do such analysis for some various projects, so you can check what we came up with and what we think of a certain project on the tokenomic aspect specifically. All right. Okay, it was a pleasure to have another session, and we'll come back again next week.
Yeah, thank you a lot, Patrick, for your time. It was, I think, really helpful session today.
Have fun. Bye.